Hi everyone, I'm Kashish and welcome to Who Said What. This is a show where we dive into interesting comments from notable figures across the world, whether in finance or broader business world, and explore the stories behind it. Now I'm filling in for Krishna this week, and I know I'm half as quirky and sarcastic as he is, but I will try and do my best. So please bear with me. Now, last week, Krishna shared with you a lot of commentary made by Indian personalities. This week, I'll be flipping the script. For today, I'll go over comments from people abroad, from Jamie Dimon, Howard Marks to Aswath Damodaran. So let's begin. Now, Jamie Dimon has a few things to say. Jamie Dimon, who is the CEO of JP Morgan, recently published his annual letter to shareholders, and it was honestly quite long. He talks about so many things here, but I want to focus on 5 things that really stood out for me. First, it was about geopolitics and national security. Here's how Jamie starts that section. He says, "We face the most perilous and complex geopolitical landscape since the World War II." Now, that's not just dramatic, it's a very deliberate statement he's making. He's saying that the world today is more dangerous and unpredictable than it has been nearly in past 80 years. Why? Because a lot of the global systems that kept things stable for decades, like the NATO, the United Nations, trade deals, and military alliances, are being tested right now. He writes, our international adversaries and major competitors have made it clear that their goal is to dismantle American hegemony. Now, hegemony basically means dominance. In this case, American leadership in global politics and economics. And Jamie is warning that countries like Russia, China, Iran, and North Korea want to break the global order that the US helped build after the World War II. That order made trade smoother, kept wars at bay, and gave the world a framework to work together. But now, with the war in Ukraine, conflict in Middle East, cyber attacks, terrorism, and growing military power in China, he's worried that we are moving into a world where every country is out for itself. And he says the link between economic power and military power is tighter than ever. We must recognize that economic warfare often precedes military warfare. So if America loses its economic edge, its technology, its trade relationships, its energy independence, then it also becomes more vulnerable militarily. And that, for Jamie, is a real danger. Second, he talks about inflation, interest rates, and the risk of stagflation. Here's where things get really interesting when Jamie says there also remains a growing need for increased expenditure, which may lead to stickier inflation and ultimately higher rates than markets currently expect. Translation, inflation isn't done yet. Let's go back to the basics here, right? Inflation means prices going up. Your groceries, your rent, your fuel, and to take control of that, central banks raise interest rates, which makes loans much more expensive, which they hope slows down the spending. Now, most people assume that inflation will soon fall and rates will come down, but Jamie is not so sure about it. Why? Because there's a lot of money being spent on things like rebuilding supply chains, investing in clean energy, expanding the military, and reshoring industries back to the US. All of that is good in the long run, but it pushes prices up in the short term. And then comes the word that really matters, stagflation. He doesn't shout it out, but he warns that it's a possibility. Here's what he writes. We may be entering a period of sustained higher inflation and interest rates. And it may not be a classic boom and bust cycle, but more like a 90s, 70s style environment of stagflation. Now, stagflation is a nightmare scenario, high inflation but low growth. Your salary doesn't go up, but prices do. And that's incredibly hard to fix because if you raise interest rates to control inflation, you hurt growth even more. Now, Jamie is warning that this is where we could be headed if we are not careful. Now, the third thing that caught my attention was America's fiscal position. This is where Jamie sounds the loudest alarm. He says profligate fiscal management has led to huge deficits and bad outcomes. Now, profligate just means reckless spending. And by deficit, he means the government is spending way more than it earns. Almost $2 trillion in 2023 alone. Now, Jamie isn't saying that we spend too much. He's saying we spend too poorly. We estimate that the government has lost, with proper accounting, at least $500 billion on student loans. Now, that's $500 billion of taxpayers' money that may never come back. And it's just one example. He also talks about how we treat infrastructure like an expense rather than an investment, and how both parties keep kicking the can down the road. Then he drops this really chilling line. He says that if America becomes a less attractive investment destination, the US dollar and the economy could suffer. In other words, if foreign investors lose faith in America's ability to manage its finances, they could pull out. Now, that could raise borrowing costs, weaken the dollar, and shake up the entire economy. Next up, he has something to say about China's economic strategy versus America's. Now, Jamie doesn't sugarcoat things here. He says over the last 20 years, China has been executing a more comprehensive economic strategy than we have. Let me explain what that means. See, China has been playing the long game. It's invested heavily in infrastructure, dominated global manufacturing, secured control over critical minerals, and expanded its influence in Asia, Africa, and Latin America. But Jamie isn't blindly just praising China. In fact, he talks about their weaknesses too, like a real estate crisis we all know about, an aging population, and tight government control that sometimes hurts innovation. Still, he's making a bigger point here that China is strategic and America can't afford to be complacent. He writes, and I quote, "We do not need to fear China. We just need to get our act together." That means fix their roads, invest in clean energy, support science and research, and rebuild manufacturing. He believes America has a better hand. We have energy, innovation, strong private companies, and a culture of entrepreneurship. But they are not using that hand very wisely. Finally, he has something to say on tariffs and global trade. Now, JB gets pretty detailed here and also a bit critical. He says the United States has become less focused on trade over the past decade, even as the rest of the world has accelerated their trade efforts. Now, let's simplify that. Trade is how countries buy and sell from each other. America used to lead global trade efforts, signing big trade deals and opening markets. But in the recent years, it's pulled back. And while that was meant to protect American workers, it also created a vacuum. Countries like China have stepped in and signed more trade deals globally. Now, Jamie's not saying we should go back to free trade at all costs, but he's also warning against going too far in the other direction. Because when governments overuse tariffs or subsidies, which is essentially putting taxes on imports or giving free handouts to local businesses, it can mess with the economy. He puts it like this: markets should allocate capital, not the government, lest the result is a buffet where corporate America gorges. In other words, if everyone starts lobbying for their own special subsidy, the whole economy gets bloated and inefficient. He also links trade to debt. Over the past 20 years, America has run $12 trillion trade deficit. That means they've bought way more from the world than they've sold. And to pay for that, they've borrowed. Foreign investors now own $30 trillion of US securities, up from $6.3 trillion in 2005. Now that's a big number. And it means that other countries have way more financial control over the US than ever before. If they stop buying their debt, the whole system could wobble. Now, there are so many more things he talks about, which I haven't even touched upon here. And it's definitely checking it out. I'll link it in the newsletter in the description box. Next up, there's a comment from Howard Marks on the current market. Now, a month ago, Howard Marks, who's a legendary investor and a co-founder at Oak Tree Capital, wrote a memo saying that credit, like bonds and loans, looked more attractive than stocks. And then the world turned upside down. Tariffs were slapped on, stock markets fell sharply, and the economic order that had more or less held steady for decades, that's now looking shaky. He recently gave an interview to Bloomberg to talk about all of this, and what he said was striking.
This is the biggest change in the environment that I've seen probably in my career.
Now, for most of the past 80 years, especially after the World War II, the world economy moved towards globalization. Countries became more connected, trade grew, and goods became cheaper. And as Marx says, that lifted almost everyone's standard of living.
That the Italians make the pasta and the Swiss make the watches.
It's a simple way to describe the big idea. Every country does what it's best at and then trades with the others for the rest. That's the system that worked well for decades. But now that's changing. With new tariffs and more protectionist tone from major countries, especially the US, Howard Marks says that we're moving towards a world that's more closed off, where countries want to make more things themselves. Now, that might sound very patriotic, but it also means one thing: higher prices and more inflation. Now, Marx explains it like this. For 25 years, prices of things like TVs, washing machines, and other durable goods in the US actually fell 40% after adjusting for inflation. Now, that's because so many things were imported cheaply from abroad. Without globalization, that benefit disappears.
If we don't have world trade, we don't have that benefit.
So yes, tariffs might help some local industries, but they also make everyday goods much more expensive. And that's not good for consumers or inflation. Now, despite all of this turmoil, Marx still believe that credit looks like a better bet. 6 weeks ago, high yield bonds, which are riskier but offer higher returns, were giving 7.2% annually. Now they're close to 8%. And unlike stocks, these investments come with a specific promise. You'll get paid back with interest unless the borrower defaults.
With debt or bonds or fixed income or credit, what you see is what you get.
In 47 years of investing in risky bonds, Mark says that 99% of the companies he lent to paid him back. Now, that's a solid track record, and it's a level of predictability he doesn't think stocks can offer him right now. There's a popular belief that stocks give 10% return over the long run, but Marx points out that this average only holds true under certain conditions, like when stock prices, measured by something called the price to earning ratio or a PE, are at normal levels. Today, the PE ratio is pretty high. So history tells us that future returns may be much lower, somewhere between 2% to 7% a year. And that's what he's saying.
So you shouldn't expect historic returns.
In other words, stock might not be the sure short thing people think they are. Now, is this the time to buy or run? With stocks falling and prices looking cheaper, should you be buying?
Bloomingdale's just put everything on sale.
Mark says that's what's happening in the stock market. Things are cheaper. But just because prices are lower doesn't mean they've hit the bottom. And there's no way to measure whether they have. The world is too uncertain.
Geopolitics and international relationships has been shook up like a snow globe by the events of the last days.
Now, is America the best place to invest? Mark says yes, but with caution. The US still has strong economy, but he's worried about some changes. For example, the rule of law might not feel as strong. Outcomes are less predictable, and most of all, America keeps piling on debt. He compares it to someone with a golden credit card.
The US has behaved like somebody who has a golden credit card where there's no credit limit and the bill never comes.
That's how the US has behaved. But if investors around the world lose confidence in the dollar, in Treasury US bonds, and in government's discipline, then that bill might finally be due. And that would be serious. So, what now? Marx doesn't offer a simple answer, but he does offer some perspective. When markets fall, most people panic and run. But that's exactly when great investors start looking closely. And he says it makes no sense to say.
It doesn't make any sense to say, just a minute, I did XYZ when the price was 100. Today the price is 90, so I'm going to boycott it.
So I'm not buying anymore. If anything, that's the time to pay attention, even if it's scary. Because in a world that feels like a snow globe, the one thing that investors can do is stay calm, think clearly, and look for opportunities that all the chaos leaves behind. And next up, I have something from Aswath Damodaran, who's the Dean of Valuation. Aswath Damodaran wrote a piece recently that really stood out, not just for how he broke down what's happening in the markets right now, but for how he framed the idea of a crisis. He called it the anatomy of market crisis, and in it, he shared a way thinking about market meltdowns that I found both simple and honestly very powerful. He says that every crisis tends to follow a cycle. It starts with a trigger, some event that shocks the system. Now, that could be economic, political, financial, doesn't matter. And then investors react the only way they can. They start selling. Prices fall, risk premiums rise, which basically means investors now want more return to take the same amount of risk. Money rushes into safer places like government bonds or gold. And slowly, the impact spreads from markets into the real economy. Businesses pull back, consumers cut spending, growth slows down, sometimes there's a full-blown recession. Over time, even after the panic fades, expectations about the long-term growth or inflation might shift permanently. That's exactly what happened in 2008 after the Lehman collapsed. It's exactly what happened in 2020 after COVID broke out in Italy. And now Damodaran says it's starting to happen again with tariffs. Now, he wrote this just after a new round of massive tariffs were announced by the US. And while this isn't the first time we've seen tariffs under Trump, the scale this time is pretty wide. These aren't just about China anymore. The tariffs are aimed at almost every major trading partner the US has, big or small. Countries like Canada, Mexico, and even allies in Europe and Asia. And it's not just about protecting American industries from unfair competition. This time, the tariffs are based on trade deficit, which means any country that exports more to the US than it imports is being penalized, regardless whether they're actually doing anything unfair. Now, the markets understandably freaked out. Within 2 days, US stocks lost over $5 trillion in value. Tech stocks alone lost nearly $1.8 trillion. Risk premiums jumped. Investors started demanding higher returns for holding stocks. Bond spreads widened, signaling that lenders were getting nervous too. So, if you go back to Damodaran's framework, trigger, market reaction, aftershocks, and eventually an economic slowdown, we are right at the beginning of that cycle. The trigger was the sudden and broad tariff announcement. The market reaction has already started, and now we're bracing for the aftershocks. What might those look like? Well, countries could retaliate by slapping their own tariffs on the US goods, which we've already seen happening. Or they could shift their supply chains to avoid dealing with America at all. Investors might start pulling money out of the US stocks. Global companies that rely on open trade may have to completely rethink how they do their business. Even if this doesn't cause an immediate recession, it could lead to a long-term damage. Tariffs can raise prices for consumers. They can disrupt supply chain. They can create uncertainty, and businesses hate uncertainty. All of this could slow down economic growth, not just in the US, but globally. Now, Damodaran even says, and this is important, if we measure the success not by how big the economy gets, but by who gets what slice of it, then maybe tariffs could help workers gain more relative capital. But that's a very different way of looking at things. So is this a full-blown crisis yet? According to Damodaran, not quite. But we're in the early stages. And if we continue down this road with tit-for-tat tariffs, global uncertainty and falling investor confidence, it could really turn into one. And here's what's wild. Trump seems to be doubling down. In recent weeks, he's floated the idea of universal tariffs, a baseline 10% duty on all imports. It's not a targeted measure anymore. It's a blanket tax on the rest of the world. He argues that this will protect American jobs, bring manufacturing back to the US, and make trade more fair.
Jobs and factories will come roaring back into our country, and you see it happening already. We will supercharge our domestic industrial base. We will pry open foreign markets and break down foreign trade barriers. And ultimately, more production at home will mean stronger competition and lower prices for consumers. This will be indeed the golden age of America. It's coming back. We're going to come back very strongly.
But almost every economist disagrees. They say this will raise prices, hurt consumers, and could spark global retaliation, which we've already seen. If this is the opening act, then Damodaran's crisis cycle gives us a chilling preview of what Act 2 or Act 3 might look like. And we've seen this movie before. So the question is, are we walking into another slow-moving crisis, this time built not around a virus or a bank collapse, but around tariffs and trade wars? And if so, what do markets, more importantly, people like you and me, need to prepare for? And that's it for this week's Who Said What. We'll see you in the next one. Yeah, from the top. हाँ, वो यहाँ से पीछे से एक बार यस यार थोड़ा और तेज करना पड़ेगा आपको यस नहीं यार फिर से हल गया यस थोड़ा और ऊपर 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 यस बिग नहीं बिग यस स्पेशली आफ्टर वर्ल्ड वॉर 2 वर्ल्ड वॉर
World War.